I know, Mark, you have an eye on what's happening in South Korea again. We're expecting maybe the government to step in or the regulators to step in to address the leverage ETFs part of that story. Is that something to be welcomed? Is that what's needed? There is this incredible volatility, and the Kospi's down again today.
So those announcements we're expecting in 2 hours' time. They probably won't be game-changing. They'll probably kind of raise the minimum deposit required, change how a little bit of the rebalancing happens. But I think what's important here, it's a Korean holiday tomorrow. So these announcements are basically coming at the end of the week when the Kospi is closing kind of near the lows after a large correction in the last few weeks. And we're going to get the reaction in lower liquidity futures or US ADRs or US-based 2 times ETFs, etc. So there's the Hong Kong 2 times ETF, which will trade. So I think there's a chance for kind of a very misplaced and oversized reaction, even though this won't be game-changing. And I think technically it's not looking great that we're kind of closing this week at the low, because we are closing the lows because there's no trading tomorrow in the benchmark index. So I think that the price action in semis, in chip stocks, is remaining globally extremely poor. And I think Kospi is the leading light for that. So I think we've probably got a bit more pain in that section next week.
And Mark, I want to take it to the oil market, because I was just listening to Owner speaking there and thinking a little bit about how the dynamic now on the Strait of Hormuz is a little bit different than it was in the first half of this conflict, and the question of the sort of binary nature of the open or close of the Strait of Hormuz. When it's closed, the market can freak out. It can sort of push prices higher and higher and higher. That puts pressure on Trump. When you don't have clarity on that, the market is going to have a much harder time pricing that. What kind of risk do you think is associated with that kind of condition?
Yeah, I think there's 2 things here. I think it's not just that the changed narrative on their moves. We've talked about that quite a bit this week, about how people now are realizing there needs to be a structural high premium oil. But it's what's happening in Russia, Ukraine. Right. Arguably, that's, I won't say it's more important, but it's as important because it's happening at the same time as people are realizing that Hormuz is not going to normalize this year. I mean, it might have periods of higher flow, but we're not going back to the way it was. We saw this before with what happened around the Houthis and around the Red Sea. So that normalization doesn't come through. So oil prices are going to be slightly higher than we were thinking maybe a couple of weeks ago. However, the one other facet is that we've realized that there are a lot of fossil fuels out there, and the supply is large.
Do you think that's why? Because the market reaction to the producer prices and consumer prices, that's backward-looking, looking to June, was positive. And we saw yields down, we saw repricing of the Fed. And yet we know that what is happening, what you've detailed, is real and material. Is there a disconnect, or are the markets seeing that this is still an oversupplied energy market globally?
I mean, we've got to remember this is a supply-side shock for inflation. And therefore, if we're going to have inflation purely because of supply chain disruption, there's the whole COVID debate. Do you want to be hiking rates anyway? So it's easier for the Fed to argue, to kind of look through that and kind of dismiss the fact that they haven't had inflation anywhere near target for a gazillion years. So I think it's more about the Warsh Fed reaction function, which people are still trying to work out, and what the overall committee reaction function is. I'm still in the camp that they're going to try doing nothing for as long as possible. Ultimately, we might get a hike in September, but that's assuming the market's still super strong. And I think there's more fragilities out there in the market.
And I remember Mark Cudmore, before the AI boom, before that was the conversation that was dominating the table, I'm much more sort of bearish, a little bit more worried about the risks on the horizon. Thinking about this AI boom, it seems everything we're hearing today in the last couple of weeks, it's got more runway. We've been talking about it here. What about the risks that are building out under the surface? How are you guys taking a view of sort of that unwind if and when it comes?
So my story hasn't really changed for the last kind of year. So that, I think the bubble keeps on inflating until an earnings season changes. And what I'm looking for in earnings season is a slash in CapEx. So I think it is a tremendous AI CapEx bubble. I think it's going to be very painful when it happens, but I don't think you can preempt it. And I think is this a turning point now? I don't think so. Yeah. But I'm open-minded. But basically, I think you've got to stay underlyingly positive until we get that capex reduction. However, as we discussed, since May, I think we're in the much more volatile stage. And I think the volatility we've seen in the last 2 months is what we're going to get for the next 2 months. But like the prior bubbles, that volatile stage lasts about 6 months. So to me, my base case is we're another earnings season away always. But I'm going to be open-minded to every single hyperscaler earnings report. As soon as capex gets slashed, that's game over.